Hello everyone. In this video, we'll learn about GDP and related concepts. So GDP is the market value of all final goods and services produced within a country in a given period of time. Now, these are things that you need to understand, so we'll go over them one by one. First of all, market value. The output is valued at market price. So whether the good is actually worth a lot more or worth a lot less, that is not what we are concerned with. We are just concerned with what is the market value, what was the price at which it was actually sold. Second thing is of all final. So we are not taking into consideration intermediate goods. So let us take an example that wheat was produced in the economy for rupees 100. Now that wheat was sold to someone who makes flour. This person makes flour and then sells the flour at rupees 150. He purchased the wheat at 100 and sold it to the let us say a baker who bakes bread for rupees 150. Now the baker buys this bread, the flour at 150, creates his bread and sells it at 200. Now if I add the market value of all products, it will be 200 plus 150 plus 100, which is 450. But that is clearly not right, because eventually what do we have in the economy? We just have bread worth rupees 200. So what is happening if in the first case is that we are double counting. When the value of the wheat has already gone into the bread, similarly the value of the flour, the value added in the flour has already gone into the bread, we should only take the market value of that bread. That is why you do not take into account the intermediate goods which are used to create more goods. Had this wheat been sold to, let us say, someone, a final consumer who would have used it himself, or let us say the flour was sold to a final consumer who used it himself, then obviously it would be added. So this is kind of an important distinction which you need to remember. Goods and services, well, both tangible goods like food, clothing, cars, and intangible services like haircuts, house cleaning, doctor visits are included in GDP. Produced. Now, we take transactions which involve production of goods in this particular time. So it does not involve transactions of goods produced in the past. So let us say a car was produced in the economy in year 1999, and then this car was resold in 2005. In 2005 this car was not produced, so this will not be part of the GDP. So that will only be used when it was actually produced in 1999. Within a country means it is a geographic concept. We'll come to this later also. So you need to remember that GDP is a geographic concept. It depends on where we are trying to find which areas GDP we are trying to find in a given period of time, because it's a specified time. It's not like, okay, what is your asset base which is at a particular point in time. This is during a given time period. So what was the GDP in this particular year? So what was all the production, all these market value of all final goods and services produced within a country during, let us say, the year 2015. Okay, now there are various measures. This again is a little important. NDP, which is the net domestic product, is GDP minus depreciation. Whenever you have a concept called net, it is your gross minus depreciation. So what is happening is, while new products are coming in, the products which were produced by you in the previous years is getting depreciated. So what is the final, the goods that exist in the economy is the new products, but you minus the depreciation with the wear and tear that the old products have endured. So hence you get the NDP. Okay, GNP. GNP is GDP plus factor payments from abroad minus factor payments from to abroad. What does this mean? Let us take an example again of someone, an Indian, who goes to London for, let us say, a temporary time period for 5 months and works there, and he earns some money. So that money effectively, that is not money using whatever service he is providing. That money obviously doesn't get counted into India's GDP, but it will be counted in India's GNP, because that is net it is factor payment from abroad. So this person, because he's an Indian and he's earning that money, effectively it gets added into the GNP of India. So, and similarly, if let us say there is let us say British person who's living in India and earning money, that money is being created sort of in India. He's, let us say, rendering that service in India. So it will be counted in the GDP, but it should not be counted in the GNP. So GNP basically measures all this, the value created by the nationals of a particular country. It is not a geographic concept like GDP. GDP only cares about what is being done within the confines of India. GNP says we don't care about what is happening within India. We care about what is happening to Indians. So hence GNP is a nationality based concept. Okay, so GNP, like I said, measures the total income earned by nationals. Similarly, NNP is GNP minus depreciation. Like I told you, any net concept is the gross concept minus the depreciation. Now when we say national income, what is national income? National income is NNP, this that we just measured, at factor costs. Now NNP you have understood, I hope. It is basically the net income earned by nationals, but at factor cost. Now what is this concept of factor costs? Factor costs is basically market price minus taxes plus subsidies. Now I would like to elaborate this a little bit. Factor cost basically means, see, any product which is produced requires you to make certain payments to the factors of production. That is, you will pay wages to the labor, you will pay interest to capital, you will pay rent to land, and you will pay profits to the entrepreneur. These are called the factor costs. Now, but the market price is supposed to include all that, right? But it includes a little bit more. Firstly, there are taxes. Now, in the market price, as you may know, you add taxes. You always hear that this is the market price inclusive of the tax. So that is the VAT or the sales tax or whatever, as you may know. There's another video explaining some of the taxes also. So in the market price, you include the tax, but that tax is going to the government. It is not going to any of the factors of production. There are 4 factors of production, as I said: labor, capital, entrepreneurship, that is entrepreneur, and land. But government doesn't figure in that. So we need to subtract the taxes. Taxes is kind of an additional thing, so which is not going to the nationals of the country. So from the market price, I subtract the taxes. Similarly, there could be a subsidy. Now let us say there is a good which the government considers to be very good. So let us say milk. So let us say after all this, after paying to all the factors, the milk is getting produced at rupees 30 per liter. But the government feels that no, this milk is something very good and all people should have it. So they say, okay, we will give you 10 rupees subsidy on milk. So you please reduce the price of milk to 20. So the entrepreneur says, okay, so I will sell the milk at 20, you give me 10 rupees, I am okay, I get 30. So the market price effectively becomes 20. But when the entrepreneur is paying to all the factors of production, he is paying how much? He is paying 30 because he takes 10 from the government. So, but because he gives more to the factors of production, when we want to capture that, we need to add back the value of the subsidies. Because the market price in this case will only be 20, but to capture the real picture of the economy, we need to take 30. So we add back plus 10 of subsidies, which becomes 30. So that is the concept of factor cost. So national income, you must remember, is net national product at factor cost. So if at this stage you should be confident enough if I give you some numbers, this is the GDP, this is factor payment from abroad, this and that is depreciation, you should be able to calculate the national income. Okay, now let's talk about GDP and economic well-being. We talk about economic well-being. So GDP is the single best measure of the economic well-being of a society. Economic means money terms. GDP does capture everything that is going on in the economy. So it does measure, it's a good measure of well-being of a society. GDP per person tells us the income and expenditure of the average person in the economy. So if I divide the GDP total by the population, it will give me a rough idea of an average person in the economy. Higher GDP per person indicates a higher standard of living, obviously. Like in India, the GDP is very high. But if you divide it by the population, you all know per capita GDP is not that high, which means our standard of living is not that good. So obviously GDP is not a perfect measure of happiness or quality of life. So for instance, you might be very rich, but let us say if your girlfriend or boyfriend leaves you, then I'm sure you will not be very happy. So similarly, your quality of life may not be good if you have all the money in the world, but you are, let us say, you don't have freedom, or you don't have freedom of expression, or there are other things which define quality of life. So GDP is obviously not a measure of that. Okay, other issues with GDP as a measure of well-being. First of all, there is no distinction between beneficial and harmful economic activities. So if I am selling guns to children, it will add to my GDP, but obviously it will be a harmful thing, and so the overall well-being of the society comes down. Similarly, divorces. If there's a divorce, there's a lot of economic activity generated. There's a lawyer who gets paid, and there could be like other things. But it is, let us assume that it is reducing the overall well-being of the society. Similarly, there are various other bad things that you can think about, which would reduce the well-being but increase the GDP. Similarly, there are many beneficial activities based on basically love, care, etc., which are not financial transactions, which do not contribute anything towards GDP. So, for example, parents who take care of their own children contribute nothing to GDP. If your mother is taking care of you, then it is not counted as part of the GDP. But if you have a babysitter to take care of a child, then that is taken into account as GDP. So, which is obviously very dichotomous, because the mother is doing exactly the same job, but because we're not paying her money directly, it counts for nothing. Similarly, GDP takes no account of how income is distributed. So if I have a country where the rich are super rich and the poor are super poor, your per capita GDP will be alright, but it will obviously be an incomplete picture, because we are not because everyone's purchasing power is not growing or is not equal. Similarly, okay, so we are leaving out things like environment, where toxins are being emitted into air, etc. So all of which contribute to real well-being. So if there is a country where there is a lot of pollution, the health of the people will keep getting impacted, but we will still say that it's a high GDP country. So obviously it's not a measure of well-being. Okay, this is just something, a chart that you can just see for economic wellness. Consumer debt and income distribution is important. Environmental wellness, noise pollution, air pollution, physical wellness, whether somebody has a severe illness or mortality rates. Mental wellness would be indicated by antidepressant usage and psychotherapy patients. Workplace wellness, unemployment and workplace complaints. Social wellness, discrimination and divorce rates. Political wellness, individual freedom, local democracy, quality. So this is just to show you that there's a lot apart from money which is important. Okay, so then came the concept of gross national happiness. It is, first look at the second point. It is officially used in Bhutan, where Gross National Happiness Commission is charged with reviewing policy decisions and allocation of resources. So whenever they have to take a policy decision, instead of looking at the impact it is going to have on the GDP, they have something called gross national happiness, where they see what will be the impact of this particular step or action on the gross national happiness. So it measures quality of life or social progress in a more holistic and psychological terms than only the economic indicator of GDP. So there is no exact quantitative definition of gross national happiness, but elements that contribute to gross national happiness are subject to quantitative measurement. So here we will not get too much into detail of gross national happiness, but this is just to tell you that GDP is more of an economic concept. While it is absolutely imperative for you to understand GDP, it is definitely not the whole picture, because it misses out on a lot of non-economic issues like the ones I just mentioned, and hence there were various other measures that came, and gross national happiness was one of these. It's sort of important because it was developed by a country which is one of our neighbors and one of our most friendly countries, and it is also a good thing because it tries to measure how happy their nationals are. So that's about it on this. Thank you for watching. Hope you like the video. Comments and suggestions are welcome. Thank you.